Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, educational language. I'm your host here at AlgoBot, and today we're exploring an expert advisor called Turning Point Density Breakout. This one is built around a fascinating idea borrowed from statistics. It measures how often price changes direction, and it uses that rhythm to judge whether the market is trending cleanly or simply drifting sideways. Over the next few minutes, you'll learn how the strategy reads that rhythm, how it combines it with a classic price breakout, and how it manages every position with an automatic stop and target. Let's dive in. So what does this expert advisor actually do? At its heart, Turning Point Density Breakout is a breakout strategy with a built-in filter that tries to tell the difference between a smooth, directional market and a noisy, choppy one. It does this using something called the turning point density. Here's the intuition. A turning point is simply a bar where the closing price is a local peak, higher than the bar before and after it, or a local trough, lower than both neighbors. If price were behaving like a pure random walk, statisticians tell us that roughly 2/3 of interior points would be turning points, because the series keeps reversing direction over and over. That number, about 0.667, is our baseline for randomness. Now, when a market trends smoothly, it stops reversing so often. Consecutive closes push in the same direction, so the turning point density collapses well below that baseline. A low density therefore signals a clean, low-noise directional environment. And that is exactly the kind of tape where a breakout has a better chance of running rather than getting trapped. A high density, at or above the baseline, suggests a choppy, sideways market that the strategy prefers to avoid. The expert advisor watches a single symbol on a single time frame. It works out the density over a look-back window of closes, checks the direction of the market over that same window, and then waits for price to break out of a recent high or low range. Only when all three of those conditions line up does it consider taking a position. Every trade is protected with a stop based on the average true range indicator, and the profit target is set as a multiple of that same risk distance. Who is this style suited for in an educational sense? It's designed for traders who want to study how a statistical filter can be layered on top of a breakout, screening out noisy conditions before committing. Remember, this is a learning tool. Trading always involves risk, and losses are a normal part of the process. Let's walk through the exact logic the expert advisor follows, step by step. Everything happens once per completed bar, so the strategy is calm and deliberate rather than reacting to every tick. Step 1 is the measurement. The strategy looks back over a window of closes, 22 bars by default, and counts how many interior bars are turning points, meaning local peaks or local troughs. It divides that count by the number of interior bars to get the density, a value between 0 and 1. Step 2 is the regime filter. The strategy compares the density to a threshold called MaxDensity, which defaults to 0.45. Remember, a pure random walk sits near 0.667, so a threshold below that demands a genuinely smooth, low reversal tape. If the density is at or below the threshold, the market is classed as trending. If it's above, the strategy simply stands aside. Step 3 sets the direction. The expert advisor looks at the net displacement across the window, the newest close minus the oldest close. If that difference is positive, the regime is pointing up. If it's negative, the regime is pointing down. Step 4 demands a fresh breakout. The strategy finds the highest high and the lowest low of the prior breakout window, 10 bars by default, excluding the bar that just closed. For a long signal, the just completed bar must close above that prior high. For a short signal, it must close below that prior low. Step 5 is agreement. A long is only considered when the market is trending, the displacement is positive, and price breaks above the prior high. A short needs the mirror image, trending, negative displacement, and a break below the prior low. All three parts must line up. Step 6 is management. If a position is already open and an opposite signal appears, the strategy reads that as a regime flip and simply closes the position, stepping aside to re-enter on a later bar. It never stacks trades in the same direction. When it does enter, it places a stop a set number of average true range units away, 2 by default, and sets the take profit at a reward to risk multiple of that distance, 1.8 by default. So the potential reward is planned to be larger than the amount risked on each trade. Let's read through the meta-editor code on screen. At the top are the input parameters you can adjust in the tester. Window is how many closes the density is measured over. Max density is the trending threshold. Breakout bars is the range the price must clear. ATR period, ATR stop multiple, and reward ratio control the stop and target, and lots sets the order size. In the middle you can see the core decision. The strategy divides the turning point count to get the density, then sets the trending flag true when that density is at or below max density. It measures the net displacement between the newest and oldest close in the window, and it reads the just completed close. Now look at the two signal lines. The long signal is true only when the market is trending, the net displacement is positive, and the last close is above the prior high. The short signal is the mirror, trending, negative displacement, and the last close below the prior low. When the long fires, the code takes the ask price, places the stop one risk distance below it, and sets the take profit that same distance times the reward ratio above it, then calls trade.buy. When the short fires, it takes the bid, places the stop above, and the take profit below by the reward multiple, then calls trade.sell. Both sides are symmetric, with the stop tied to the average true range and the target planned larger than the risk. Let's bring this to life on the chart. In the lower panel, you can see the turning point density, our custom oscillator. It has two reference lines, the random walk baseline near 0.667 in red and the trending threshold at 0.45 in green. When the gold density line sits high, near or above the baseline, the market is choppy. When it drops into the green zone below the threshold, the market is trending smoothly. Look at the first three candles. Price is chopping back and forth in a tight band, one bar up, one bar down. Notice how the density is riding high, up around 0.7, even above the random walk baseline. This is exactly the noisy environment the strategy is designed to sit out. There is no clean direction here, so nothing happens. Now watch the fourth and fifth candles. Price starts pushing in one direction, closing higher and higher, and the density line falls sharply, dropping through the trending threshold at 0.45. The market has become smooth and directional. At the same time, price is climbing toward the blue range high near 1082, the top of that earlier consolidation. On the sixth candle, the breakout happens. The bar closes decisively above the range high near 1082. The density is comfortably inside the trending zone, and the net displacement over the window is positive. All three conditions agree, so the buy entry marker appears. The strategy places its stop 2 average true range units below the entry and sets the take profit at 1.8 times that distance above. Follow the next two candles up. Price continues to run in the same clean direction, closing strongly, and notice how the density stays pinned down in the trending zone the whole way. That low, steady reading is the strategy's way of saying the move still has smooth, one-directional character behind it. On the eighth candle, price reaches the take profit target. That's our long trade completed, closed at the planned target rather than left to chance. Because the target was set at 1.8 times the stop distance, the trade aimed to return more than it put at risk, though of course no single outcome is ever certain. Now the character of the market shifts. Around the eighth and ninth candles, price stalls at the highs and the density line climbs back up above the threshold, out of the green zone. The trend has paused, and the strategy waits patiently. Watch what happens next. Price rolls over and begins closing lower, candle after candle. The density line drops back down through 0.45 into the trending zone once more, but this time the net displacement across the window is negative. The market is trending downward. On the 12th candle, price closes below the blue range low near 1062, breaking beneath the recent support. Trending regime, downward direction, and a fresh downside breakout all line up, so the sell entry marker fires. The stop is placed 2 average true range units above the entry, and the take profit is set the reward multiple below. Price then continues lower over the final two candles, making fresh lows, and the density holds inside the trending zone, confirming the smooth downward push. It reaches the take profit target on the last candle. That completes the short trade. And here's an important detail about position management. Had the strategy still been holding the earlier long when this downward signal confirmed, it would have read that as a regime flip and closed the long first, stepping aside rather than fighting the new direction. It never holds opposing trades at once, and it never stacks extra positions in the same direction. Notice the pattern across both examples. The strategy only acted when the density confirmed a smooth market, the direction was clear, and price broke out of its recent range. When those pieces did not agree, it simply waited. And that brings us to the end of our look at Turning Point Density Breakout. We covered the core idea that a low turning point density signals a smooth, trending market well below the random walk baseline. We walked through how the strategy combines that regime filter with a directional breakout, and how it manages every trade with an average true range stop and a reward-to-risk target. We also read through the actual MetaTrader 5 code for both the long and the short side. Remember, everything here is educational content only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading carries real risk, and losses are always possible. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.